Hello, friends. Today, I just wanted to provide a insight on the West Asia crisis and how it is impacting Indian equity market at large. If you look at a $10 increase in crude oil prices will impact 12 to 15 billion to India's import bill, which is will increase the current account deficit, which will increase the inflation, which will also affect the GDP. And what it does is that the raw material cost will be increased to most of the manufacturing companies, and their logistics and travel related movement will also get impacted. And higher cost of raw materials means lower profit to the companies, which will definitely impact because of this war. And the operating expenses for these manufacturing companies will also go up. So what government has done is that even in the last 10 to 12 years, if you look at India has mixed ethanol blending by E20 up to 20%. So what it has saved is that it has saved close to 1.4 lakh crore of cost, which has saved for the Indian through foreign exchanges, and 277 lakh metric tons of crude oil for the past 12 to 13 years because of this blending. And now recently government has also announced 1 lakh crore as a uh, economic stabilization fund, just to ensure that all these shocks have been taken care of, so that it does not affect the industries as well as the common man at large, right? And you also notice that US has removed sanctions on crude oil from buying from Russia. So it will also temporarily reduce the prices going up substantially, because suddenly have you seen that last week it has gone up to 110 to $120. Now it is hovering around 80 to $100, which is within the manageable space. So all this will affect in the short term. The currency movement is also got affected because there is a huge FA outflow. Because whenever there is a huge outflow, the rupee will also depreciate. So all these are all temporary things which we are going to experience. It is not only the Indian economy which is facing this issue; it is the same across the globe, right? But if you look at the data, you will understand that how any war-like situation has happened and how the recovery happens. For example, during Kargil War, the market has come down by 10%, but in the next 1 year, it has gone up by 22%, in the 3 years by 40%, and 5 year by 41%. Similarly, during the World Trade Center attack, which has happened in September 2001, even though the market has gone down by 48%, and within after that next year, it has gone up by 47%, in 3 years by 45%, as well as in 5 years by more than 30% compounded annualized growth rate. So this is the same during 2008 global financial crisis, and this is the same even during the COVID. From that year, how things have gone up substantially. And we need to understand is that government has made a lot of structural changes in keeping the economy back into positive action by reducing the GST, by providing income tax concessions and all this, and that is already factored very positively. As we've seen a lot of vehicle sales which has happened, and the consumer discretionary spending will also go up. So all this is definitely temporarily affecting the economy. We hope the war gets over soon, sooner than later, so that it brings in normalcy, and this heightened volatility can be reduced. But at this point in time, what we also need to understand is that quality companies are available at a much cheaper valuation now, because if you look at the P, which is around 23, 24, has come down to 20 levels now, even in the large cap, and there is a good amount of correction which has also happened in the middle small cap. So as an investor, if your investment horizon is just 3 years and above, then this is all very, very, very good time to invest, because as you always know, equity never moves in a straight line. It is an asset class which will always have a period of volatility, but these are all very good time because fundamentally we are very, very strong. Our GDP numbers are growing, our interest rates are on the lowest side, and there are so many other factors. The capacity utilization has gone up across the thing, and government has been spending really well on infrastructure, and there are so many new sectors which will also get the benefit. So, as an investor who have already invested, stay the course. These are all the time to just not to worry about the market drawdowns because this is unprecedented fall, which is that is 10 to 15% is what is the fall across the market universe. So stay the course, stay invested. I can assure you that the coming years will be highly rewarding because we are in a structural bull run and our growth to become the third largest economy in the world is not too far. Thank you for listening.